So, how do you actually trade Forex? It's a simple question, right? You know it's about trading currencies, but when you're on your platform and you click buy on a currency pair, what are you really buying? Is it a contract? Is it the actual currency? That's the core question we're going to get to the bottom of today. Let's just dive right in. Look, you know it's the biggest market in the world, you know it involves currency pairs, but what are the actual financial instruments you're trading? What is really happening behind the screen when you place that trade? That's what we're here to unpack. Okay, here's the plan. First, we're going to look at the entire Forex trading universe. Then, we'll break down trading on an exchange versus the over-the-counter market. After that, we'll see exactly where we, the retail traders, fit into all this. And finally, we'll connect it all to a really powerful financial concept, derivatives. So let's start at the very top with the entire Forex trading universe. To really get a handle on this, it's super helpful to think of it as two totally distinct paths, two completely different ways of doing business. And this slide, this lays out those two parallel universes perfectly. On one side, you have your centralized exchanges. You can think of these like the New York Stock Exchange, but for currencies. Everything is regulated, transparent, and uses standardized contracts. Then, on the other side, you have the over-the-counter market, or OTC. This is this huge, decentralized network where big players trade directly with each other. Seriously, understanding the split is the key to everything else we're going to talk about. So let's start with the path that probably feels a bit more familiar, especially if you've ever traded stocks. We're talking about trading on a centralized exchange. The classic instrument you'll find here is something called a currency future. It's a formal, legally binding contract to exchange currencies at a price you agree on today, but for a specific date in the future. And the keywords there are standardized and future date. And, just for a little bit of fun context, these things aren't new, not at all. Currency futures were actually created way back in 1972 at the Chicago Mercantile Exchange. Yep, while everyone else was out there rocking bell-bottoms and platform boots, these guys were inventing modern currency trading. Then you've got currency options. Now, these are kind of similar to futures, but there is one massive game-changing difference. An option gives you the right to buy or sell, but not the obligation. You can walk away. And that flexibility? That's the whole point. And finally, probably the most straightforward product for most people, currency ETFs. It's pretty simple. A big institution buys up a bunch of currencies, puts them into a fund, and then sells shares of that fund on an exchange. It's an easy way to get exposure. And guess what? It trades just like a stock. So what's the catch? What's the trade-off with going this route? Well, the huge pro is that it's highly regulated and transparent. You can see all the data. But the cons? They're pretty significant. The market isn't open 24/7. The liquidity can sometimes be a lot lower, and you're almost always paying commissions and fees. All right, now let's pivot and look at the other side of the Forex universe, the over-the-counter, or OTC market. And let me tell you, this is where the vast majority of Forex trading actually happens. It's the playground for the big institutions. The very first thing you have to get your head around is that this isn't a market like you might picture it. There's no big building, no trading floor. It's a global, 24-hour electronic network where the real heavy hitters, we're talking major banks, pension funds, huge corporations, trade directly with each other. This is what's known as the interbank market. And what are they trading? They're trading something called a spot FX contract. This is a binding deal to physically exchange one currency for another. And even though it's called spot, the actual delivery of the cash usually happens 2 business days later. But make no mistake, the whole point of this transaction is the actual physical delivery of currency. So, that begs a pretty big question, right? If the giant institutions are all trading spot FX contracts for physical delivery in this exclusive interbank market, what in the world are retail traders, people like you and me, actually doing? Well, my friends, this is the big reveal. Okay, so here's how it works for us. We, the retail traders, we don't get a key to the interbank market. Instead, we trade in a secondary market that's created by our brokers. A great way to think about it is like a retail store. Your broker buys wholesale from the interbank market, adds their markup, and then acts as your direct counterparty. When you click buy, they are literally the ones selling it to you. Now, this is absolutely crucial. We are not trading the same spot FX contract as the banks. We are trading something different, called a rolling spot FX contract. And the most critical detail is right there in the definition. The currency is never physically delivered. The entire system is built specifically to prevent that from ever happening. So how do they do that? How does that work? Well, it's through a clever little mechanism called the Tom Next rollover. Basically, if you have a trade open at the end of the day, your broker automatically closes it and then instantly reopens an identical one for the next day. This keeps pushing the delivery date forward, day after day. And for providing this service, you either pay or earn a tiny interest fee called a swap fee. But why go through all this trouble? Why is it so complicated? Well, it all comes down to one single word: leverage. With just, say, $2,000 in your account, you might be able to control a $100,000 position. Now just imagine for a second that you had to physically deliver $100,000 worth of euros. You can't. The whole rollover system exists for one reason: to make sure that never, ever has to happen. And all of this brings us to our final and maybe most important section. Because what we're trading is a contract whose value is derived from an underlying asset, the currency pair, but we never actually own that asset, well, that means we are fundamentally trading a derivative. And the most common name for this type of product around the world is a contract for difference, or CFD. It's super simple, really. It's just an agreement between you and your broker to exchange the difference in the price of a currency pair from the moment you open the trade to the moment you close it. It is quite literally just a bet on which direction the price is going to move. And look, this isn't just me getting technical. This is a regulatory reality. Regulators in huge markets like the European Union and the UK have officially ruled that a rolling spot FX contract is a CFD. They see it for what it is: a tool for speculation on price, not for ownership. And this really gets to the heart of it all. When most people say they're trading Forex, what they're really doing is speculating. The goal is simply to profit from the changes in an exchange rate with absolutely zero intention of ever taking physical ownership of any currency. So this table just puts it all together really nicely. On an exchange, you've got futures, options, ETFs, all available in the US. Then, in the retail OTC market, you have that rolling spot FX contract, which in the US is often just called retail Forex, where you have no ownership. And finally, you have products explicitly called CFDs, which are basically the same thing, but are actually illegal for retail traders in the US. So here it is, the main takeaway. For most of us, trading Forex isn't about buying and selling currency. It's about betting on its direction using a derivative. And that leaves us with a really big question to chew on. What does it mean for our financial markets when we can all trade the value of an asset without anyone ever actually needing to own the asset itself? It's definitely something to think about.